Hi guys, welcome to the channel. Today I just want to talk about a potential opportunity in a coal company. So this is a company that produces metallurgical coal in the US and is currently being marked down by the market this year. It's down a lot, nearly 50%, because the price of coal has really plummeted. This is mainly because of less demand from China. So China, particularly for metallurgical coal, imports nearly half of it worldwide, and they're currently going through a real estate recession. So there's been a lot less demand. The supply continues to be has similar levels because it's quite inelastic, and therefore you have such a big price decrease. So you could think of this as a commodity cycle business, and we're currently potentially near the bottom. So that's why I think there's a good value opportunity here. So I'm just going to talk a little bit about this business in particular. So Alpha Metallurgical Resources is on the New York Stock Exchange, listed as ticker AMR. It's a pure play metallurgical coal business. I'll talk a little bit about the different types of coal later, but on a high level there's thermal coal and there's metallurgical coal, and this is the latter. It's got a market cap of around $3 billion, revenues of nearly $3 billion as well, or just over $3 billion. They operate near the Appalachian Mountains in the US. This is around Virginia, West Virginia. They supply around 20% of the total amount of metallurgical coal that the US exports worldwide. So they're quite a big player. I think there's a long runway of demand for this from steel manufacturers because, as I'll mention later, this particular type of coal is essential for making steel. And they aren't spending lots of their cash flow, which they do generate a nice amount of, on growth opportunities. They are spending most of it on buybacks. And because the stock price is so cheap at the moment, because this particular sector is overlooked or ignored by investment managers who have ESG mandates, they're buying back their stock at a really reasonable price. So that's what I think the investment thesis is for this company. So just to quickly talk a little bit more about the company, they have around 4,000 employees. They produce around 15 million tons of metallurgical coal per year. They've got over 20 years of supply left in their mines. They have about 15 underground mines in total, 7 surface level, and also some plants to prepare the coal for export. They export worldwide, 25 different countries, mainly to Asia, a lot to India. There's two types of coal, as I mentioned. There's thermal coal and metallurgical coal. The former is to produce electricity, and that's what's being phased out, particularly in the developed world at the moment. The second is metallurgical coal, also known as coking coal, and this is an essential ingredient for production of steel. So steel manufacturers worldwide will be, the main demand side player for this product. Just to give an example, typical way that steel is manufactured, or at least 70% of it, is in a blast furnace. And you need metallurgical coal because it acts as a reductant, which means it changes iron ore, which you can mine from the earth. It changes that into iron. It takes the oxygen out of iron ore and leaves it with just pure iron. And then through a further process, you convert the iron into steel. But the most important is you need the metallurgical coal, i.e. the carbon, which is in that coal, to act as a reductant, i.e. to remove the oxygen from iron ore. And first you've got to make iron, and then, as I said, you make steel after that. So there's lots of demand for this product at the moment, particularly, well, not from China though, but from other players in the market. Particularly India is a growing area who are requiring more and more of this because of the growth that they're seeing. And really, you can't have growth of civilization without steel. You can't have a green revolution, with the steel that's needed for the wind turbines, etc. So I don't think the demand for steel is going anywhere. So let's look at the moat that this company has. Well, apart from some of the more obvious things like the permits, it has the mines it already has established, difficulty of setting up new mines because of people not wanting them in their own backyard. What the moat is this business is run very well. It's run by a management team which are highly regarded in the industry. They're veterans, and they have return on equity of 28%. Now, return on equity you can break down into leverage, margins, and asset turnover. This company, AMR, does not have the highest margins. One of its competitors does, which I'll touch on in a sec. It doesn't have leverage, which means how is it achieving such high return on equity? Well, it's because of its asset turnover. It's double as good as squeezing revenue out or coal out of its mines as its next best competitor. So it really is good at turning over its mines and extracting coal from them in an efficient way. And that's really what gives it its moat and its high return on equity. If we look at its competitors, I think we can ignore everyone apart from the US. In Australia, there's very high royalties of up to 40%, which makes the Australian producers uncompetitive. If we look at just the US then, the only real competitor to compare to is Warrior Met Coal. They are a pure play metallurgical coal operator as well. They're based in Alabama though. They are the lowest cost operator. They've got a lower distance to ship their coal to port from, which saves a lot of money. And this is seen in their gross margin. It is considerably higher for Warrior Met Coal compared to Alpha Metallurgical Resources. For example, it's 39% compared to 24%. As I mentioned, AMR really is a genius in the way it extracts from its mines in a really much more doubly productive way. It can turn over its assets way more efficiently. Its balance sheet looks very healthy at the moment. Lots of cash, a conservative amount, 340 million. Its cash conversion cycle is 70 days, which is reasonable. Its liquidity current ratio is 3.5. It has no debt, so it's going to be difficult for it to get into any trouble. I think the opportunities here really is the buyback opportunity. Being able to buy back at such a low PE ratio is, I think, really unique. And I think they're going to be buying back this stock really until there's no shares left. The PE is 6 at the moment, which means there is a earnings yield of about 16%. It means there's no point even considering using that free cash flow for anything else other than buybacks, unless you almost have a guaranteed return from expansion projects or investing in new mines, which is considerably above 16%. And that's a big hurdle. So buybacks really make sense, in my opinion, at the moment. They've really eaten up a third of their shares over the last 5 years. They're going hard on this. They're a 3 billion market cap company, but in the last 2 years, not this year, but before, they've spent 500 million per year on buybacks. They are really going for it, and they're very shareholder friendly. It's looking a little bit like tobacco companies 20 years ago or so, where people were moving away from the stocks, but really they've performed very well over the last 2 decades because the price has been just hit down, but their earnings are still high because they've got a product that people need. So there's a lot of free cash flow, which the most efficient way to deliver that back to shareholders is through buybacks rather than dividends, and that's what AMR is doing. If we look at valuation, if we look at Warren Buffett's way of valuing, simply owner earnings, so take free cash flow, add back depreciation, and then take off maintenance capex, which is just meant to give an indication of actually what cash is available for owners. If we do that and take an average for the last 5 years for AMR, we can see it's $350 million per year of owner earnings. That's averaging for a commodity cycle. If we then discount that, we can use the current risk-free rate of 4.5%, just to keep a unified rate there, not have to worry about finding our own cost of capital, etc., cost of equity. We get a valuation of 7.7 billion. The current valuation is just under $3 billion. There's a very large margin of safety there. Even if you think it's a low discount rate, there's 190% margin of safety there, which I think compensates for that. So that's a valuation on a very high level. The long-term risks really, I think, could be changes in technology. At the moment, 30% of steel production is made from electric arc furnaces, which is just recycling steel, melting it down and reusing it. I don't think that's going to take over blast furnace, using metallurgical coal, because that relies purely on recycled steel, and you can't recycle your way to growth. In countries like India, they need to be producing a lot more steel for their civilization and their buildings and their growth. There's talk about hydrogen becoming a replacement for coal in making steel. Over the very long run, this could be decades. They can't make it cost efficient at the moment. It's at least double the price of using coal, and it's too far off to really be considering that. But hydrogen takes a lot of energy actually just to extract from the atmosphere as well, so it's a lot more expensive than just using coal. Just a quick look at met coal prices. I mean, currently they're around $210 per ton. This isn't massively above where the cost is for some of these producers, and that's a good thing for us because it means there's a limit to how far the price will keep going down, until some of the players in the market start dropping out. And our company AMR has no debt. It's got a lot of cash. It's going to be very tough to really go into problems here. So just to summarize, I think this is a company which is really a quality company run by great people. It's debt free. It's a simple business. It's easy to understand. It's at an unreasonable discount at the moment. It makes a lot of cash, easily being used for share buybacks. 11% of the shares are held by insiders, which helps to align interests. And if we're near a bottom now in the coal commodity cycle, then it could be a good time to buy. Hold for a good few years. So that's my thesis on AMR. I hope someone finds that helpful, and thank you very much for listening.